Hi everyone. This is your domain consulting guy on Abodo, back with the second video of the insurance consulting series. So, if you have gone through the first video where we have covered the basics of insurance, so what do we mean by insurance? What can be insured? What can't be insured? We looked at the different risks which are there. We went through the different principles of insurance. We looked at the different features of insurance and the different types of insurance, right? So if you look at the different types of insurance, you will see that overall at a high level, insurance can be broken down into two types, right? One is life and the other one is non-life, right? And within non-life, we can categorize non-life as well into health insurance and general insurance, right? So that's what the overall categorization of insurance is. Today in this video, we are going to deep dive into what is life insurance, right? And what are the different types of life insurance which we can buy in the market, right? So all of us know and all of us have experienced, gone through this experience of buying life insurance, or at least have, felt the urge of buying a life insurance, right? So we all know that we are mortal, and at some point of our life, we are going to face death. So that's why what we want to do is we want to purchase life insurance and we want to insure our families so that things go well even when we are not there, right? So when we look at life insurance, interestingly, there are so many different types of products which are available, which are given by the different companies, and you have to choose one or multiple out of these, right? So you need to know properly what suits your purpose, right? Based on your age, your liabilities and your preferences, which one do you go for? So the first type we are looking at here is term insurance, right? So what is a term insurance? Term insurance is nothing but in the word there's a thing called term, right? So we are buying it till a specific amount or a specific timeline, right? So we are buying it for a particular age. So today I am say 35. I am buying a term insurance till my age of 80. So that timeline is fixed. So in this type of insurances, hence the premium is really low. Why it is low? Because there is always a chance of not getting anything back out of this insurance if nothing happens to you till this year, till this age of 80, right? Which you are finalizing while buying the premium. So that's why it's called term insurance. And these type of insurance has very large coverages like 1 crore, 2 crore and things like that. But the premiums are also low. But as I told, there is always a chance of losing out of the benefit if nothing happens to you till that term, right? Now we are going to look at what is whole life insurance, right? So again, in the name, it is very clear that it is giving you insurance for your entire life, right? Till the time you live, it is going to cover you, and only in whatever age you at the end of the day one faces death. After that, the family gets the entire coverage amount from the insurance company. So there's always a 100% chance of getting the coverage amount. There's no chance of losing out, and hence this has a higher premium value. So you have to pay out premium at a higher level compared to term life insurance, whole life insurance, correct? Now we would look at the third type. There's something called a universal life insurance. Okay, this is interesting. So what is universal life? This is giving you a new thing. This is giving you flexibility. Okay, so when you buy an universal life insurance, you have the flexibility of paying higher premium or lower premium based on your financial condition at that point of time, right? There's always a cap, higher and lower cap, within which you can change your premiums, but you have that flexibility in universal life insurance, right? And this entire, whatever you are paying, there are two parts to it. One is cost of insurance, and the other part is a cash value element, which gets generated based on the amount of money you are paying to the company. So this cash value, your family is also entitled to get back once you face the incident, along with the death benefit, right? Another important thing, this allows policy loans. You can take loans against the amount of premium that you're paying in this policy in universal life insurance. Now the fourth type, variable universal life insurance. So there's a difference in word called variable compared to the previous one. What is variable here? The cash value is variable, right? In the previous type, the cash value is generated out of a fixed rate that is given by the company. But here, the cash value amount is generated is linked basically with a lot of sub accounts which operates like mutual funds. So you as insured, you have the independence to invest in different kinds of products which are mostly like mutual funds, and hence this is a high growth potential. Your amount of cash value will increase if you invest in proper funds, and similarly the cash value can go down, and it can even go down to negative if you invest in funds which are loss making funds. So that's our variable universal life insurance, right? Now we would look at the next two types, which are again similar. One is ULIP, unit linked insurance plan. The other one is endowment plan. But there's a difference, right? What is ULIP? In ULIP, apart from the cost of insurance, the entire amount is basically invested to the market, right? So it's a market linked benefit that you will get along with the principal amount that you pay. Okay, so that's the unit linked insurance, and you get this entire amount even if the term you pay for the entire time and you don't face death after that term as well. So that is ULIP for you. And then what is endowment plan? Endowment plan gives you lesser amount or lesser benefit basically in terms of the savings, right? Or in terms of the cash value that we are talking about, right? So ULIP gives you a higher return. Why? Because the entire amount is market linked. In endowment plan, the entire amount is not market linked, right? It is more of a savings kind of a policy. So along with the death benefit, you also get a savings, the savings plan or the savings benefit. So basically, say for example, you pay a premium of say, which is totaling to say 2,70,000, you will get a entire amount of 3 lakh back, right? So it gives you say about 20 to 30,000 back, which is similar to kind of a savings account return that an endowment plan gives you. So you receive the payout with a guaranteed return if you live until the maturity date. That's the benefit that it is giving to you, an endowment plan. Now looking at the sixth type or the seventh type, this is group insurance plan. Okay, so what is a group insurance plan? Again, from the name, this group insurance plans are mainly bought by employers, right? And then you as an employee, if you're associated with a company, you get the benefit of that kind of a plan. So normally we get group life insurances or group health insurance from your insurers, and the insurer, the company, buys this kind of insurance at bulk, right? Say for 50 employees or 100 employees together, and through buying in bulk, they get that benefit of discount from that company, and then you as an employee, you enjoy that benefit of a group life insurance. Then there is another type called money back policy. Now all these policies we discussed so far, these are none of these are money back policies. So you don't get the money back from these policies till the time the maturity happens. But this is the only type where you can start getting monthly installments back from your policy even before the maturity date of that policy. And that's the significance of this money back policy. Now coming to the penultimate type we will talk today, this is mortgage life insurance. Very important. In today's world, a lot of couples, they together go ahead and take a loan against a mortgage or a house that they're buying, right? And then along with that, if you buy a mortgage life insurance, what it does is it gives you the independence or the insurance of that loan, even if one of the person faces a death, right? So in that case, the entire loan is basically paid off by that company, and the other person who continues to live don't have to bear the burden of paying that loan in that situation, right? So that is called mortgage life insurance. And now coming to the last type, which is called retirement plan, right? So what is a retirement plan? I haven't written anything in specific here. Why? Because there are different kinds of customized retirement plans along with insurance benefits that you normally buy, right? So say for example, if in LIC, if you see recently they have come up with something called a Jeevan Lav policy, right? Where you are going to pay for say 16 years, but after 25 years, that is when you are nearing your retirement, for example, after that, this entire principal amount that is accumulated along with the bonus, this company will give you as monthly installments back after the policy has matured as a monthly installment throughout your retirement years, right? So that is kind of a retirement plan that you can buy. Again, these are customized plans. You can decide based on the kind of product that any particular company is giving you. But then that is also another type of life insurance. So these are the 10 types of life insurance which are there in the market. So I would again talk about the fact that you can obviously go ahead and select one or multiple of these products based on your age, based on your liabilities, based on the kind of return you are looking at, and based on the kind of coverage that you want to get out of that insurance policy, right? I hope you liked this video today. In further videos, we will deep dive into each of these types, and we will see that which type is suited for which kind of people, and we will also look at further features of all of these products. Thank you for listening in. We will meet in the next video.